Stanford University.
I've been in entrepreneur shoes before. I was a CEO for an enterprise software company for a year and a half before I joined Bill Draper, and had some ups and downs there, but for the most part had some tough times. It was right after the bubble, was collapsing and getting, we'd get a customer and we'd lose two, and we'd get another customer and we'd lose two more. It was a difficult time. And so I've sat on the other side of the table from investors. So when I was raising money back then, I had a mentor, a guy named Rick Miley, who was the founder of Global Village, which was a Mike Moritz, Sequoia-backed company that did the Macintosh modem and took the company public. And he sort of taught me his impression of the venture business. And so whenever I'm dealing with entrepreneurs now and talking about financing, I always try and put myself in their shoes. And one thing that I think is important is to get feedback from an investor when you're talking with an investor. And many investors don't really want to tell you what they're thinking because they don't want you saying, oh, that guy's an ass, or he doesn't understand our business, or whatever. The real bummer is that when you're an entrepreneur and you're raising money and you're talking to people and they literally don't give you any feedback, or they lie to you because they don't want you to know what they're really thinking. And so you can spin your wheels for weeks and sometimes months on end with no really solid feedback. So as David said, I like to give direct feedback to people that I'm dealing with, but I always say, hey, it's just one person's opinion, and you might get 10 opinions from 10 different people, but hopefully you'll get 10 opinions from 10 different people, and then you can decide what pieces to take and what pieces to ignore in the process. So I wanted to, the topic for today is funding your startup. And so I wanted to talk about it kind of from both perspectives. What does it from an investor's perspective mean? What are the different types of investors that are out there? What is it from an entrepreneur's perspective? And not only should the investors put themselves in your shoes, but you should put yourself in the investor's shoes, because then it will help you to think more clearly about what direction the conversation is going, what makes sense for you, and how to structure the company properly. So I'll discuss the different types. I'll kind of give you, what investors think, both positive and negative, and what you should think, both positive and negative. And then also talk about, at the end, if there's time, one methodology for how an entrepreneur should describe their company to a potential investor, so that you've basically hit on all the important things and there's nothing left. There's no questions left in the process, and if there's a step to move forward, or just to say, well, that wasn't a fit, and move on. So when you guys, and I assume you're taking this all because you're interested in entrepreneurship, many of you will have the pleasure of being the pain of being a CEO and raising money, or being part of a founding team or the senior management and raising money. But what does an entrepreneur think when they're starting a business? And I think typically it's, this is going to work. And if you didn't think that, you wouldn't be doing it. You wouldn't be spending years of your life risking, some students drop out of school to do it. Some people mortgage their house. Some spend their parents' money. There's certainly a lot of decision. If you didn't think it was going to work, you wouldn't do it. So you're thinking this is going to work. But what is an investor thinking? An investor is thinking this probably isn't going to work. And that's just a basic, two sides of the table. Well, an investor wants it to work, and if they think it might work, they're willing to invest. But you can't go in and expect any investor to immediately say, oh, this is definitely going to work, because it's just not the way we think about it in the process. And what does an inexperienced investor think, like an angel who just made some money at a startup, but that hasn't really been in the investor group before? And what they typically think is, wow, this is another Facebook and I can't lose. And they're looking at this like there's only upside here. This is going to be a wonderful thing. And they haven't had that negative experience so far to realize how painful it can be in the process when things aren't going the right way. And so depending on who you're talking to, a VC or a professional investor or an angel or somebody with limited or no, if your parents with their retirement money, they think different things. And you have to think about that when you're pitching them and asking them for money. What do I think when I'm looking at a company? I kind of summarize it saying is that this probably isn't going to work, but as a venture investor, and I'll speak on David's behalf as well, I think it's pretty similar. We think, wow, this is really interesting, but there's a good chance it won't work out. It's going to take years. There's going to be sleepless nights. There's going to be real problems. We may get sued. We'll have people fighting within the company. We'll have big customers drop out in the process. But if it works, then our fund, a big VC fund, can make hundreds of millions of dollars potentially, or more. Hopefully something like Facebook, but that's really few and far between. Most entrepreneurs are thinking, I'm going to build a business that's going to be a great business. So that's not what we're looking for. VCs are looking for a company that can become huge and grow quickly and be worth so much money that our stake in the business is worth 100, 200, $500 million. And so if you do the math and you sell a 20 or 25% of your business to an investor, that means your business needs to be worth $500 million, $1 billion, $2 billion in the future. And look around at how much companies are worth. And look at a company that goes public on NASDAQ or New York Stock Exchange and is worth $2 or $3 billion. Look at how much their revenue is. Look at how many people they have. Look at how many years they've been in business. And rarely is it a very easy thing to get to. But that's our expectation when we invest, and we're looking at it. And so if you want money from David or me, you have to be thinking, I think my business can be worth billions of dollars. And it may take 5 or 10 years to get there, but I think it'll be worth billions in the process. Let's talk about what the different types of funding sources are. And the way Ernestine described it, she said, here's a couple of ways of looking at it, and I think about it in terms of there's venture capitalists and there's different types of VCs. We'll get into the details there. There's super angels or microcap VCs, and there's different types of them. I'll break them out as well. There's angels, which I'll describe, and then there's kind of what some people call friends and family, and some call friends and family and fools. And usually because they don't know what they're getting into in the process. So on the VC side, there's hundreds of venture capital firms, and if you look at the directory for the National Venture Capital Association, what is it, 300, 500, some ridiculous number.
Active VCs in the last year.
And that's what those are firms, and so each firm has several partners. I don't know whether on average it's 3.5 or whatever, but so that's 1,000, 1,500 investors. In reality, I don't think there's more than 20 firms that make money in this business on average over time. Maybe it's 15, maybe it's 25, but kind of in that range. And so it's a pretty good business if you're in that group, and it's a pretty tough business. Like, not making money means you could be in business for 10 or 15 years at some venture firms and never make money for your limited partners. And imagine how frustrated you guys would be in a job if you literally for 15 years you worked hard and you didn't make any money. It'd be a pretty depressing thing to do. So as a result of there being like two types of VCs, which I'll call those that make money and those that don't make money, then you have different size VCs. You have some like NEA, which New Enterprise Associates, which has billions of dollars to invest, like literally $5 or $6 billion on one end of the spectrum. And you have a small VC fund. Shasta, they probably raise 150 million per fund or so, and they invest half of that money every 3 or 4 years or so. So it's a huge difference. And so what you get from that is a different expectation for what the funds are looking for. Now, every VC is expecting to make 2 or 3 or times or more of the money that their venture fund has raised, which for Shasta might be to make $500 million in total, and for NEA might be $10 billion in total. And it's pretty hard to make $10 billion. Pretty hard to make, actually, it's pretty hard for Shasta to make $500 million. I'm not picking them out in any way, but it's pretty hard to make $500 million as well, right? And then you have other firms who, everything in between, some big, some small, and on average, I think they're just trying to move money. They're really hoping that they might hit something on the head, but they know that most of the really interesting companies, for the most part, get picked off by the top 15, 20, 25 firms. So if they're not in one of those firms, it's just kind of tough because you've got picked over stuff that you're looking at. And so when you guys are raising money, you know, what's the right fit for you? Is it a large firm? Is it a small firm? Is it a top-tier firm? Is it not a top-tier firm? We'll get into those details. I just wanted to describe, like, in terms of scale. In terms of micro-cap or super angels, they used to be called super angels. They changed their names to micro-cap after there was this thing called Angelgate about a year ago where they ostensibly were colluding, which I wasn't there, I don't know, but it made for a good story.
Although interestingly, I had a conversation yesterday with Mike Arrington, who was the one who reported on Angelgate and is now a VC, and he said, well, now that I'm a VC, I see that differently.
Yeah. Yeah.
Maybe there was more to that story than I thought.
Yeah.
It was like, okay.
Yeah, there was apparently a dinner where a bunch of super angels got together and were trying to discuss how they should work on deals together and such, and Mike claimed that they were colluding and it was a violation and whatever. It's not clear what really happened. And there's different types of micro-cap VCs or super angels. I mean, maybe you guys have all heard of Dave McClure, who has this company called 500 Startups, and he has funded 250 companies in the past 24 months. So that's a lot, right? How many is that per week? How many is that per day? You know, it adds up, right? Then there's guys like Michael Deering, and maybe some of you guys have taken his class in the D School here. He's a wonderful guy, a lot of experience out of eBay and product focus. There's Mike Maples and Ann Murico, who maybe many of you have met, who run Floodgate. There's True Ventures, there's First Round Capital. There's kind of a handful of them. And I think they kind of break out into, there's Aidan Senkit, who's out of Google, who runs Felicious Ventures. There's a whole bunch more, but those are just kind of a handful. And without saying anything negative about any of them, and frankly, Draper Richards, where I was before, was a microcap VC. So I have direct experience of having done that. I kind of bucket them in three different places. One is more like the Dave McClure model, where it's more of, he wants a portfolio of a huge number, hoping that one of those companies will hit it big. Spray, I was trying to be nice. It's been called spray and pray before.
He's defended it. If you go to TechCrunch, he said, oh, it's spray and pray, but those of you who think that's not the right way to invest are fools. So he's perfectly happy to call it that.
And he believes in the model, and the thing is, there haven't been very many people like him doing it at that level, so the jury is, I don't believe it works. I don't think the math works, but we'll find out in a few years. Yeah.
What's the difference between his model and what Ron Conway's been doing for years?
Yeah, and ask questions anywhere along the way. I mean, don't be shy to ask to it. So I think they're very similar in what Ron is doing and what Dave is doing. I actually think Ron is more helpful to his companies than Dave is. I think Dave has concentrated more deals in a shorter period of time. So what you get from Dave is some money, but he just doesn't have a lot of time for you. Like if you need help or introductions and you email him, he literally must get 300-400 emails a day with people asking him to do stuff. There's just not enough hours in the day to get any help. And he doesn't have a big organization helping him out, whereas Ron is incredibly well-networked guy and maintains people that work for him whose job is purely to filter those requests and help. If you need introduction to somebody at Time Warner, and somebody on Ron's team will make an introduction for you. And I think Ron does he's been doing it longer and does a better job at providing some added value, but it's usually not so much the money, and the amount of money that Ron puts in is usually smaller than the amount that Dave McClure puts in. Then there's firms which do a high volume, but not anywhere near the volume that Ron Conway or SV Angel and Dave McClure are doing, like Aidan Senkit. He did probably 75 deals in the first 4 years, which is, you can go to his website and you can just see a lot of companies on there. And I got to give him credit for having 13, 14 exits, but nothing really big has come out of it. So I think he's profitable as a business, but the amount of money that he has pulled out personally for it is not a lot of money relative to how much it could be if he actually had a big hit. But he likes his model. He's very happy with it. He's been changing his model slightly, where I think he invested in Rovio in the most recent financing, which was $1 billion-ish valuation. So he bought, 0.001% of the company or whatever it is. And I think he was, he got the relationships from that, but it seems unlikely he's going to make huge money from doing that in the process. But he likes that in his network. There's companies like Mike Maples, to me, looks like a venture capitalist. He may be investing less money per round than a bigger firm. Instead of investing millions per round, maybe he's investing $500,000 or $750,000. But he does like a similar number of deals per year that David or I do. And he takes board seats, and he's very helpful. And I think, to me, he may be a micro-cap VC, but he looks just like a venture capitalist to me. And Mike Maples and Miraco are somewhere in the middle there, where they do a higher number of deals, but not the volume that Aiden, I'm sorry, I don't remember how to pronounce his name. Not the same number of deals, but they do take board seats, and they're very helpful, and some of their companies look quite interesting. So there's just a whole, if you just want somebody to give you money and leave you alone and maybe introduce you to a few buddies who might give you money, and the total of money you're going to raise is a few $100K, and you don't want them to bother you at all, you go to Dave McClure. If you want somebody to be helpful and spend time with you and come to board meetings and sit down and do a product review with you and help you recruit people, then you go to Michael Deering. And they're very different types of people in the process, if that's kind of the range of money that you're raising. And then in the friends and family and fools department, I think the challenge there is that the investors really don't know what they're getting into. I'll do angels separately, but friends and family and fools, I think, is usually because people know you, they feel like, well, I can trust you, and therefore it's a good investment, and they get a little bit colored in their decision process, and they really don't understand the risk that they're taking. And I have been witness to more than a couple of companies literally lose their parents' entire retirement benefits. I witnessed one guy lose his parents' house that they had paid off. Like, they mortgaged it and gave him the money because they wanted to be helpful, and they just had no real understanding how risky this type of stuff was. I've seen family members ruin relationships between each other because a brother has bet on a brother and it wasn't what he thought it was, and the money is gone, and it's ugly. And so it's not something I recommend all that highly, because I think the investors coming out of family in particular can get you in a situation where you maybe damages your relationship for the rest of your life with a family member, which would really suck. And friends can be a similar thing. My own father, I think he was a bondholder for his entire life. And we reached the peak of the bubble in February or March of 2000 when he put $50,000 into his friend's startup company, which subsequently folded 6 months later. And I still have to listen to my dad bitch about that. Like, Dad, you made the decision, and you put the money in. He really didn't understand what he was getting into in the process, and it hurt his relationship with his friend, who'd been a friend of his for a very long time. Angels, especially in Silicon Valley, are an interesting group of people. Generally, they've made money at one of another company, like a Google or a Facebook or an eBay or whatever it may be, and they've been around enough to understand the risks that are involved. They only invest a certain amount of money, and maybe they're worth $10 million, so they invest a total of $500,000 or $750,000 or $1 million, something which is real money, but if they lose it all, it doesn't really impact their life. They understand the risks for the most part, and a lot of time it's just they're excited by it, and they want to get involved, and they want to help out a company, and their friends are doing the deal, and it'll be fun, and they like the product, but they're not as financially, it's hard to generalize, but many of them are not as financially motivated. They just want to be involved, and then there's another class of which I've seen over the past few years. We have like some guy who started a company, and at Series B, he sold $500,000 of shares, and then his company folded, and he takes his $500,000, he splits it between 30 companies at $15K a piece, and it probably not even a qualified investor by SEC regulations, but is just like throwing, and it's fun, and they're in the flow, and I'm in this deal, and I'm in that deal, and oh, I'm in Airbnb, and I'm in one guy I was talking to the other day who I think, I'm very happy for him. He said that he put 10 grand into Dropbox. It's worth $6 million right now. And he said, what should I do? I said, sell half now. Because he's like 25 years old and he has no money. He probably shouldn't have been investing in the first place. He's like, but it could become worth so much more. And I said, yeah, but it could become worth so much less. The argument is if you sell half, you're happy no matter what, because you made money. If it goes up, you made more. If it goes down, you made money. So it's really, Bill Draper said, you don't lose money taking a profit. But he is an angel, right? But the amount of money that he's providing to companies is really small, and it's more just like a fun thing to do. And I think he understands the risk, but he doesn't really care. Because for him, the 500K or so he made was kind of immaterial. It's like, hey, 500K, what do I do with this? I don't need it. You know, when I was a kid, people made 500K, they bought a Corvette. Nowadays, they spread it around in a bunch of different startup companies. It's just it's a different way of spending money. So
I was talking to an angel investor in LinkedIn, and his angel investment had turned into $20-ish million. And he said, well, what do you think? Should I sell it? You know, and I said, well, it sort of depends how much money you have outside of LinkedIn, et cetera. He said, well, no, I really don't have much. It's basically my money. And I said, well, let me ask you this. If you had a bank account with $20 million, would you put it all in LinkedIn? You know, would you spend, oh, I gotta take all 20 million I have and buy LinkedIn shares? And he said, no, that'd be crazy. I said, so then you should sell. Like, what, you know, what is the difference? You have this liquid
or sell
thing.
90%.
I said, so how
like
much
that,
would
yeah.
you put in LinkedIn? He said, oh, maybe I'd put $1 million. And I said, great, sell 19 million. Like, and let the other run. But, you know, it is tough because you become emotionally attached and it's working. The other one that's interesting is Reid Hoffman, who, you know, who did well in PayPal, made some number of millions of dollars, but basically didn't care. But he is not a guy who cares about money at all. It's just not it's not of interest to him. To the degree that it's of interest, it's only because it's an enabler of other things. And he thought it was an interesting point in time, and so he decided he would invest like half of the money he had made, maybe even more, which we would typically say is a crazy thing to do. Like, oh, why would you invest so much when you likely lose it? On the other hand, he invested it in things like Facebook and others, and so he turned his half of some number of millions of dollars into some number of billions of dollars. So now he's got to keep investing, because, you know, how you invest half of that?
Yeah,
that's a lot.
You spray and pray. Yeah. No worries. And so, I mean, those are like a group of different segments of VCs, big and small. Then there's, as I said, there's microcap VCs or super angels. There's friends and family, and so I want to focus a little bit more on the VC piece, because that's where I come from, and I think one of the most interesting parts, one of the most interesting things I see in Silicon Valley is a perception that not everybody, but most people who start a business think that raising venture capital is just sort of part of the process. Like, okay, I'm going to start a company. What do I do? Well, okay, there's going to be starting the company piece and getting founders, and then there's going to be the raising the venture capital piece, and then there's going to be the exit piece, and they kind of leave the other stuff out in the middle. I mean, that's kind of how it starts. So, team, and then money, and then exit. The great majority of companies that David and I see are not candidates for venture capital. Venture capital is a very special type of financing. I define it purely as for those companies that have the potential to exit and provide their investors with multiple hundreds, if not more, of profit to us. So valuing the company at 500 million, $1 billion, $2 billion or more in the process. And most of the companies we see never have that potential to get to that scale. And whether that's, I don't know if it's 70% or 98%, but very few companies that we see have the potential to get there. But probably 70% of them, I think the people starting the company never really thought about it that way. They thought, I'm going to build a company, it's going to be a big business, I can map out how I get customers, what I build, how much revenue I can get, and so I need money to get there, and so I'm going to go get venture capital. And that's just, venture capital is the wrong fit if you've mapped out how you're going to get to $60 million in 5 years in a $200 million market space. And it's just not a fit, because if the whole market space is $200 or $500 million or so, even if you're doing really, really well, it's hard to be valued for a lot of money. So when you're thinking about, number one thing when you're thinking about starting your business, whether or not you need money, don't jump into the assumption that venture capital is the place I go to get money. It's just like before venture capital existed, when you needed money, you went to the bank. And a lot of people went to the bank and said, I need to borrow money to do this. And the bank would just say, no, we don't do that. You don't have any collateral, you don't have anything, and so we're not doing that business. And people would say, oh, okay, yeah, if the bank won't lend me money, then I guess I won't have money, or I'll bootstrap, or whatever it is. But there's this general perception now, like, well, I need money, so I'm going to go get venture capital. And even though it may not be a fit for venture capital, the tendency is to go from firm to firm to firm to firm to firm for a long period of time, thinking that the VCs must not see it, or there must be something wrong because they won't give me money. I just haven't found the right venture capitalist yet to give me money. But in reality, the issue is that the company isn't a fit for venture capital. You don't have the scale potential, you don't have the defensibility potential, you don't have, I guess the number one reason is scale. How big can the company be? Because we're only going to make money if it's a big business. Yeah?
So who puts $5 million into a company that's going to be worth 60?
I would call that the other 600 firms, sometimes, who don't make money. And there is a lot of that happens, unfortunately. I just, maybe it's snobbery on my behalf, but I think if I was starting a company and I thought I needed venture capital and I couldn't get anybody from the top 20 or 25 firms to fund me, I would really reevaluate, what am I missing? That, maybe 15 of those 25 guys are idiots, but the other 10 were smart, and none of them could agree that I was worth the risk to do it. So if you go through a process of trying to raise money, and like you're on firm number 38, and they're still saying, this is very interesting, but we're going to pass because it's not a fit for us, that you should reevaluate, like, I think venture capital is the right financing to raise, and all these smart people are telling me no, maybe I'm just confused in the process. Now, there are many cases where people invest, where venture capitalists who are very smart and experienced, coming from firms that make money on average, bet on companies that have some, quick growth potential, but no clear revenue model. Because there's been enough cases of companies who have turned, so Twitter has just gone into their, revenue generation mode in the past couple of years, but Twitter's pretty old now. What is it, like 6 years old or 5 years old since 6 years? 5 years since it started? David, do you know when Twitter started?
It was 5 years ago.
I mean, that's a long time for a company to not really, maybe they figured out the revenue model now, but that's a pretty long time for people not to figure out a revenue model. But it was kind of a force of nature, and lots of people were using it, and it's different, and it's not clear how they're going to make money, but it's such a social, impact on the world, where you turn on CNN and they're talking about, and tweet us at, and you see billboards that have the Twitter logo. You're like, there's something here. They're smart people, and there's a lot of usage, so they most likely will figure out how to make a lot of revenue from it. That people, investors, will bet on companies like that. I mean, Pinterest is an interesting business, and they're raising money, and they have no revenue model yet. But usage is so heavy that investors are betting it might be worth a lot of money. It's certainly not a sure thing. I mean, they don't have a business model yet, but companies with that type of usage have many times been able to generate a lot of money out of it, so it might be worth a lot of money, and then there's the gamble.
That's why it's merely valued at $200 million, not $1 billion.
Yeah.
They had it.
Like Square.
Business model.
Square valued at $1 billion plus and Airbnb at $1 billion plus. The revenue model was very clear in those businesses. People are using it. There's a transaction fee. You can say how many people are there in the world who will use this, how many times will they use it per. You can make a little math model and say it's pretty clear if this works optimistically, this is how much a company could be worth, as opposed to betting I mean, you asked the question, betting $5 million on a company that could be doing $60 million in revenue, and I'm answering, well, there's a lot of bets on $5 million for companies who have no revenue potential, but they have a lot of usage, and there's a history of companies turning that into something, and therefore, but there's also a lot who have fallen off and not worked as well. But the returns are so great for those that work that you know, ICQ sold for $400 million to AOL. No revenue model in the process, but huge instant messenger adoption. And the bet was by the investors that so many people are using this, somebody will figure out how to make money from it. And from the buyer, we don't know how to make money from this, but everybody's using it, and so there's a buyer for it. Most VCs, yeah, sorry.
I was just had a question about defensibility.
Yes.
And like, how do you determine defensibility of a young like startup?
So there's different types of defensibility for a business. One might be just smart know-how. You are like experts on something that you've developed that is not very obvious how to do, and other people have been trying to do it and haven't figured it out, but you're the guys who have done it. We're investors in a company called Bubbly, which does spherical photography. It turns on the video and it automatically stitches it into like you're standing on the inside of a bubble, a spherical photograph. And the stitching is a very hard thing to do on the fly, on the phone while you're doing it. And we're not sure if there's a market there or not, but it's very hard to do. And we've seen some other companies, even Microsoft, try and do stuff that's not nearly as good as theirs. So we say, smart guys, somewhat defensible. There's not that many guys in the world who are experts at that. Then there's like patentable intellectual property. Like, smart know-how, usually you don't even want to patent because you don't want people to know how you do it, because they might look at that and go, aha, I can think of a better way now. So that's smart know-how. Then there's IP, which David teaches, where you patent something and it's, importantly, you can identify when competitors are violating your patent. So a lot of patents, I think, they might be nice, but they're hard to prove. Anybody, you can't tell if they're violating them, and even if they are, it's hard to prove it. And then there's you know, things you hear about like a network effect. You know, if you want to own the social graph, or Skype had a network effect. So Google launched Google Voice, and Skype was already at critical mass and growing very quickly. We were scared about Google Voice, but it didn't matter. The network effect on Skype was so strong. Like, people tried Google Voice, and frankly, the product was a little bit better than Skype was at the time in terms of voice quality and such. But there was nobody using it, so if you wanted to make a call, you had to use Skype, and so Google Voice never got any traction, which is a network effect. Defensibility can simply, in many cases, be that you're far enough ahead of your competitors in complexity and completeness of your product that you can, like in an enterprise product you're selling, if you want to buy a cloud-based, a software as a service CRM system, you buy from Salesforce because they've got everything you need and it's an awesome product. And if you're a startup company offering a CRM solution, you're like, well, we've got 1/80th of what Salesforce has. It's got to be pretty hard to get customers because Salesforce is already way ahead in the process. But there's a lot of different for what defensibility is. My network effect is the most beautiful one because it's impossible to penetrate. Another one is just viral adoption. So, Hotmail was growing extremely fast when Juno, which you guys have never heard of, thought, wow, we can make money. We can be, we can catch them, we can do a good job, and then we can be the market leader. And they raised, I think Hotmail raised $600K, and Juno raised $20 million a few months behind them, and it didn't matter because Hotmail was growing so fast that by the time Juno got any traction, Hotmail had basically taken the market from them, and you don't need 2 free email accounts. You've already got your free email. So just speed and viral adoption, customer acquisition models can make it so once people are using a product, I don't think Hotmail is network effect, it's more of a viral effect. But there's different ways to think about that. Yeah.
Have you ever invested in founders that had sort of a mediocre idea, but just from meeting them and talking to them, you guys knew that they were going to do something great somewhere it might not be whatever they have right now, but maybe 6 months down the road or a year down the road, you can just tell, so you just invest in them just to keep them around?
I have not, and I don't think our firm ever has done that. And my rationale for that is, I think when you're, trying to figure something out, money usually isn't the thing that is going to help you succeed at that. And in many cases, people, I don't think I've ever had somebody say, I have no ideas, but give me some money. But people always have an idea, and if you give them some money, then you're sort of validating their idea, and then they go and waste their time on an idea which might be mediocre. And you don't say, your idea sucks, and I'm going to give you money, but only if you don't do that sucky idea. And the chances are they'll spend time and work on that product because now they have money, and they'll hire some engineers, and actually I think we'll go down a wrong path. But there are many VCs who have written checks to people that they worked with before, and I did with the Skype guys. I wrote them a check for Juiced, which turned out to be a good idea, but business didn't make it anyway. So, yeah.
So isn't that kind of what an EIR is? I mean, smart people you like that you're willing to bet on before they have an idea?
Yes, so EIR's Entrepreneur in Residence is somebody who joins a venture firm for some limited period of time, whether it's 3 months or a year, it kind of depends. Some firms pay them to be there, some firms don't. They just give them an office, a place to hang out. And sometimes they come in with an idea that they want to just have a place to work on, and usually the firms that do fund them usually give them some very small amount of money, and it's usually to maybe pay some legal bills or hire 1 or 2 developers to do some work for them. It's not something where we've done it. We've had EIRs in the past who have spent the time, and we've given them a desk and support and health insurance or whatever, just so that they could work on stuff, and one of them never came up with an idea that he felt comfortable with, and he ended up joining a big company, and one of them came up with an idea that he developed into a point, but wasn't a perfect fit for us, but another big firm funded him, and he was happy that we supported him and helped him through the process. I think we would have loved to fund him, it just wasn't a perfect idea for us in the process.
Came up with an idea that was a very good fit, and we funded it, and it's doing well. So
That's right, yeah. So different models for it. I had lunch with Simon Rothman today, who was a guy who built eBay Motors, and he's now an EIR at Greylock. And what he's doing it for is he doesn't have an idea. He's hoping that by sitting around with Greylock and seeing all their deal flow, it will either help him to find a company that he can then join, that Greylock may or may not, he can make his own decision. If Greylock funds it, all the better. But he's just looking for people to join up with, or he'll see something which gives him some ideas where he may start something on his own at the same time. But I think that's generally the best application of an EIR, if that makes sense. So I just wanted to, back to VCs a little bit. I just jotted some notes down here why VCs invest and why they don't invest. And the list of why they invest is naturally much shorter than the list of why they don't invest. So when David and I see a company, there's just a few things that we look for. And one is a really smart team, ideally that has worked together before, because that removes the risk of them not getting along in the process. A potentially really big market, some differentiated product, and a focused plan. If we see that, we'll usually fund the company. They can have no software written, they can have holes in their team, but if they have a good idea, it's focused, it's a really big market, and they're a good team that's really smart, we'll be like, yeah, we'll bet on you. So to answer your question, if there's no, any of those things are missing, I think we probably wouldn't fund a company. Those are kind of the core things in the process. And maybe one potentially really big market, when we funded Bubbly, it's very difficult to say how big is the market if you own spherical photographs. However, there's a lot of photographs taken every day. And if you can somehow get some infinitesimally small piece out of photographs that are being taken, whether it's through a mobile provider or the handset or some license, whatever it may be, it could potentially be a big business because there's a lot of photos in the world. I don't know how we're going to monetize that business yet, but at least it's not somebody saying, a product that we have no reference point on for usage in the market. Reasons VCs don't invest, number one, which I commented before, is not a big enough market. We see lots of companies that look perfectly interesting, that I encourage the entrepreneurs to proceed in their business, but it's not big enough for us to be an investor because we don't see enough upside for us. And many of these go on to be great companies. They're profitable, they make 5, 10, 15, $30 million a year. The founders are very happy with it. They make a lot of money from it in the process. It's just not the scale that we're looking for. We see sometimes entrepreneurs who have sold companies that they built for a small amount of money is one of the things that can scare away a VC, because we want to go big, and generally people who sell companies for small amounts of money, small meaning a few $1 million or $10 million or $20 million, will do it again and again, because when they're offered the money, they're always like, well, it worked last time, like it was kind of tough, and then I made $8 million after taxes, and now I've got 8, and now I'm going to do it again and get 16, and the really big money in our business is made by people saying no when somebody tries to acquire the business. Now, if a company is not doing well and the founders want to sell the business, we're all for it. It's like, you guys know, and if you say we should sell it because it's not going to be big and now you figure that out, then by all means sell it. But we worry about founders who have really interesting companies who are going well, and they get an offer and they sell the business. And Mark Zuckerberg could have easily sold Facebook for $1 billion, and it's not common knowledge, but they had a handshake agreement to sell for $1 billion to Yahoo. And in final documentation, it came back, and Terry Semel had changed the number to 850 million, and Zuckerberg said no, because he said his number was $1 billion, and had Semel said $1 billion, then Yahoo would be one of the biggest companies in the world. But Semel was over-optimizing around price, and Zuckerberg at that time just said no. But I mean, who knows how Yahoo would have screwed up Facebook too. So now you have one of the largest, most interesting companies, impactful companies in the world, which easily could have been sold multiple times along the way, but the fact that the entrepreneur said no, like the value just kept going. And the most interesting companies, people try and buy them all the time. Skype, 6 weeks after launch, AOL offered $400 million. A couple months later, News Corp offered $850 million. A few months later, Google offered $1.5 billion. And the founder's like, do you think we should sell? I'm like, dude, like every 4 months you wait, it doubles. And they're like, yeah, I guess you're right. And I said, what's your price now? And they're like, $3 billion. And then eBay offered $3 billion, and they said, well, I think $3 billion is pretty fair. And actually at that time, growth had stalled during the summertime. And so they're like, okay, now we have a sign that maybe it won't double again, so maybe we should sell the business, right? And so anyway, so my comment was, when we worry that somebody might sell a company, it's a reason for us not to invest, even if we think it can be a really big company, because if they do sell a company for $20 or $30 million, then we were spending our time on a company where we made almost no money, compared to we could have been spending our time on a company where we could be making a lot of money. Tend to be scared away from consulting backgrounds for the most part, from big company backgrounds. A lot of times when a market gets kind of hot and there's a lot of financings going on, you'll see a team come in and it's like 2 guys from AT&T, 1 guy from Hughes Network Systems, and 1 guy from Nokia, and they're like, now it's my time to start a business. And when you see that, you know that they perceive there's no risk, so that means there's a lot of risk, because they're really not entrepreneurial in their spirit. Single founders, something that tends to scare me personally. Have you ever funded a single founder? Yeah. I think 2 people together are good to bounce ideas off and come up with a better solution, and 1 guy might be insane, and you're better off to have 2 people. Less likely to have 2 insane people working together than 1.
Says if you can't find one other person who will work with you, that's not a good sign.
Yeah.
You know?
Can I ask a question?
Yeah.
So in our first session, David
Z
Z said that there are founders and founding teams, but there's usually like the guy.
So my next one right here was, if there's not a clear leader in the team, was my next one. So I'm being consistent with David. So we do see teams sometimes, and it's not clear who the leader is, and we say, who's the leader? And they all point at each other, or they all say, I'm the leader. And either one is not a great situation, because you either don't have a leader, or they're not focused. There is no, it's going to be an ego problem with everybody fighting for it. I have just a quick list I'll just read off here. Other things, bad decisions to date, such as some terrible terms from some prior investor, very capital inefficient, complex business models. Complexity is your enemy. It might be wonderful to have once you get big, because it can make you impenetrable, but early on, managing complexity is very difficult. sometimes a very depressed segment can be a good thing because that means there's less competition and you can have an opportunity there. But in many cases, there's some structural problem. I invested in one EDA, electronic design automation company, in the past without really understanding that market, the only place all exits had been was the big tool vendors would buy those companies. And all the tool vendors were so depressed and stuck, none of them had money to buy or value to buy any company. So we had no exit, even though we built a decent business on it. We ended up selling. We got our money back, but it was like 6 years of hard work. And there was no, when we finally were successful, there were no buyers for the business, and it was never possible to get big enough on one tool. So that was a reason not to invest. Tend to be shy away from companies with too many buzzwords. We are the collaboration eBay for social mobile, whatever, yeah. Poor team dynamics. You watch teams that argue with each other, it's usually not so great. Or one guy does all the talking, the other people just sit there and don't say anything. That's always a little bit concerning. A company that's in a space where a VC has made a lot of money in the past is something that a lot of VCs will avoid because they know how difficult and luck-driven the outcome was. But then there's some VCs who are the opposite, who are like, well, I only want to invest in solar panel clean tech because that's all I know and I'm the world expert at it. And so that's not me. But that they know what they're doing, and now they through negative experiences or positive experience, they think they know better the next time around. But you'll see both. Motivation of the founders. A lot of times VCs will say, why are you guys doing this? And when the answer is, oh, we just want to make a lot of money, is an answer that will scare away a VC. It may be an outcome of building a great company, but if that's your motivation, usually that doesn't turn into a very interesting company in the process, because you're making decisions based on short-term financial gain rather than the long-term potential of the company. That's an opinion of mine.
I was just
Yep.
thinking, what about people who are married or dating on the founding team?
So I invested in a company called Bebo, which the founders were married, and they seemed to have a wonderful dynamic, and I guess nobody had told me I shouldn't invest in married couples, and it worked out great. And
Eventbrite's doing great.
Eventbrite is doing great, and they're a married couple. I think so firms are usually, I said maybe it's average of 3.5 people per firm. Every firm has had one partner who's done it and had a terrible, terrible situation from it. Like they went through divorce and it has destroyed the company, fighting over the assets of the company. One spousal partner sleeping with some person in the company. The other, just all sorts of lawsuits and just messy, messy, messy stuff. And so if you are a boyfriend and girlfriend or a husband and wife or whatever, and you're pitching a firm, unless everything is really going pretty well already, or you already know people in the firm personally before they were just introduced to you, that's a really big red flag for reducing your probability of raising funding in the process. Their boyfriend and girlfriend are less common, but the get-around team is a boyfriend and girlfriend, and I heard numerous VCs say, I'm just not funding a boyfriend and girlfriend because they don't even have commitment to get married. And so, how many boyfriends and girlfriends break up pretty ugly? And you just don't want to have millions of dollars in a company where they're fighting because somebody didn't buy somebody an anniversary, birthday gift or something, or whatever it may be in the process.
Because that never happens once you're married.
Yeah. You just don't talk about it anymore. So to give some examples of what I've been doing in the past 3.5 years. So, August is a $400 million early stage fund, as opposed to a $5 billion or whatever. I don't know how big NEA's is, but it's maybe $2 billion or something in that realm. Just because we're a big fund, we're still early stage investors. And to give you an idea of that, 7 out of my last 10 investments were either the first money in the company or the first institutional money after a small angel round. 7 out of 10. So if you are raising money and you want $1 million or $2 million or $3 million, that doesn't mean angels or microcap VCs. Us and other big venture firms do that as well. We just do less because we tend to be pickier and we spend a lot more time on the companies. And of those 7, 4 of them had no products, just founders and an idea, like a PowerPoint. They hadn't built anything yet. And so if you're a company like that and you want to get going, there's no harm in talking to us or other firms like us, because if you have answered enough of the questions, we will happily invest on you. And microcap VCs will say, oh no, never go to a bigger fund, they'll never invest in you. I'm just telling you from the numbers, that's the way it is. And many of the microcap VCs, they're like, well, if you don't have a product yet, I won't invest in you. So we invest earlier than some of the microcap VCs, just to give you an idea. Common misconceptions about VCs. So, yeah?
Is it beneficial as an entrepreneur to have a product that you can show a VC like yourself? Like, would you get better terms?
It's absolutely beneficial. It makes life easier. If you need money to build that product, there's no harm in talking to a VC first. And then even if they say, well, I don't quite get it, if you show me a demo and you come back a few months later with a demo, then I'm thinking like, wow, they said they were going to build a demo and they built a demo. They actually do something. Because a lot of companies say we're going to do something and then you never hear from them again and they don't do anything. So we have one case of those 10 investments we made. One of them was a late stage investment where I knew the founder kind of all the steps along the way, and finally he came to me and said, now please, I've showed you Series A, I've showed you Series B, now please. And I was like, okay, I'm sorry, I should have invested earlier. And then we invested. So, yeah.
How many of these 10 companies have you provided with follow-on funding?
So probably
Participated or done the next deal?
everyone that's raised more money or needed more money.
And do you see that being one of the key benefits of raising institutional money?
Yeah, so if things are doing terribly, like all assumptions were wrong, then I think there's justification in any investor saying, I'm not putting any more money in. But if things are going sort of okay, but not quite enough yet to generate money, to generate investment from an outside investor, then you're better off to have a bigger VC, because we expect to put $15 million on average into a company. So if we invest $3 million or $2 million or $5 million at the start, and you didn't quite get far enough and you need more, and somebody else doesn't want to give you money, we're like, yeah, we got to know you, you're good people, and we give you more money. May not be at the price that you want, but if the price you wanted, usually we want you to get money from the outside because you want to set a market price. And when I say not the price that you want, it's usually we'll give you a bridge loan towards the next financing, for example. But angels and super angels simply don't have the money to do that. So they just say, sorry. Yeah?
Of the companies that you invest, how often do you actually find the company as opposed to them coming to you?
All the interesting ones we find. And there have been a few, maybe half come to us, and it's usually through somebody that we know says, hey, you should see this company. Or maybe it's a class like this, and then you go to start a company later and you call David or me or David Z or whoever it is, and say, hey, I remember I liked what you
But really, me or Howard?
First, well, you call us first. Yeah. Because his name is really hard to pronounce. But I would say the number that literally come in over email with no common introduction is 0, maybe.
So of those that you go out to, what's the percentage that say, we're good at this point?
Most of them.
Okay.
Where they say, we don't need your money, or we'll get back with you later, or if we wanted your money, we would have contacted you before, or whatever it may be. But the most interesting companies are often the ones who don't need money. And you go to them when you say, hey, I can help you make this bigger, and let me show you how. So, yeah.
How many emails, maybe like a week, you get of random inquiries incoming?
Business proposals, I don't know, 5 to 10 a day. You probably get more than that. Is that
I would say like 1,000 a year, so whatever that comes to, 4 a day.
Yeah, so kind of the same range. And a lot of them are crazy. Some of them are like, dear potential investor, and then they CC every VC in the world on the same email. It says like, they email themselves, and it's like you and 150 other people, where they went to every website or they bought a list, and then you just kind of delete, right? Or they email it and then they address it to the wrong person, or they, whatever. So a lot of them are really like that, and a lot of them are coming from, just flat out, we're an ice cream manufacturer, and we see stuff like that. Like they don't even look at our website to see that or they come and they say, I know it says you're an IT investor, but we are looking for money for real estate. Now these are maybe a few a week, but it's just a waste of everybody's time. in the process. So I don't. If the chance is pretty low that we're going to ever find anybody who contacts us direct, without an introduction, then if you're contacting us without an introduction and you're doing real estate, when our website says we're IT investors, I think is another piece.
I did have the guy send me $100.
Yeah, he got a check in the mail and it said, to David Hornick, $100, call me. But he didn't put his phone number. So we figured he failed the pretty smart guy.
They could email me and say, did you get my check? Yeah, I got your check. He said, listen to VentureCast. Howard and I talked about your check.
Yeah. So I just wanted to make a couple, I think we have, a few more minutes. No, I'll give 2 more minutes, and then I'll stop. Common misconceptions, misperceptions about VCs. So, like in anything, there's people who are disgruntled and they want to share their disgruntled opinions with you. And some things you'll hear about VCs is that they screw you, they steal your idea of your company, they fund you, and then they fire you and replace you with your friends. They want you to spend a lot of money so that they can invest more and take control of your company. My opinion is that most of these tales are propagated by people who did a very poor job with their business and they're looking to blame somebody else. But I'm sure there are some cases where some of these things are true. I just haven't witnessed them firsthand. But if you take it from a VC's perspective, what would you want? You wouldn't want to fund any company that you wanted to screw over. You wouldn't want to fund a company where you want to replace the founders. You wouldn't want to fund a company where all you want to do is pump in a lot of money and take a lot more risk on the deal. What you want, like an ideal deal for us, is a company that has, very little problems, doesn't really require a lot of work, very professional team, things go kind of smoothly, it's quickly and has a very high return potential. That's what we're looking for. But it almost never happens. Skype was an extremely fast exit. It was 36 months, but we almost died several times along the way. It just was never in the press. It was really tough on some occasions. I wish we didn't have those tough times, but I think they made it a better company in the process.
For more, please visit us at stanford.edu.